We'll start. Can you see the slides?
Yes, sir.
Right. So we are. What we learned so far at the first session is the type of risk where banks encounter. Our subject matter is the credit risk, but we also learned that there are four major areas like financial risk, operational risk, strategic risk, and regulatory risk. On the financial risk, we have credit, market, and liquidity. Then we went to study what is credit risk is. We also divide the credit risk into two areas like counterparty risk and concentration risk. Counterparty risk is when you give loans and advances to your customers, and when they default, you will have a position of NPA that's arising from counterparty risk. Because customers who took loans from you has failed to pay because they have encountered certain risk of getting their repayments correct. So we went on to see counterpart risk can be mainly managed by evaluation, proper evaluation. And then we also looked at concentration. That is, if a bank do their lending to one particular product or in region or industry, concentration will occur, and as a result, what will happen is if that particular industry fails, we will have large. Final result is uh, final result is that you will have non-performing advances, and what we learn is how to not to have non-performing advances under credit risk management. Then we looked at how we could do is on the business side. We say we do credit management as the risk owners of the bank. That is, we all face the customers, and we actually studied the first part of credit management, that loan origination. Then we did the valuation of financial analysis. What are the type of qualitative analysis? We also went to learn a little bit of internal rating system. Then once those have been approved, then you do a credit appraisal form. You get the concurrence of the credit risk management, and then you approve and disburse the funds. Now that process we went for different type of customers, starting from retail customers, and then retail customers we looked at two methods: credit scoring method and 5 C's of good credit. Then we looked at SME. SME we said that mainly decisions are taken not based on their financials, because financials accuracy you cannot guarantee, and you have to actually uh, visit the businesses, create financials for them by yourself, then check the repayment, check the collateral available, look at the track record of the customer and what future prospect he has. Then we looked at the industry what he's in and how good is his particular business, are the criteria for granting SME credit. Then we looked at corporate credit, and we looked at for what purposes generally banks give corporate credit, what is the repayment or payback. Then we went on to discuss the risks, and in the risk we find all the your customers also face financial risk. Apart from that, they have macroeconomic conditions, and then they have their own problem of management and ownerships, and certain businesses have inherited business risk. So we have looked into all these and did little bit of financial ratio analysis, and then we came to uh, how do you mitigate risk by through governance, collateral, and price. Um, we also said governance are terms and conditions you put on the um, offer letter. Collaterals is the security or third party security you take to safeguard bank from non-payment. Then we also looked at by pricing, you can actually mitigate certain risk. Then we came to this last slide. Last time, this is where we stopped, and I spoke about specialized credit because when you look at businesses, some of the businesses are engaged in import and export, and when you do import and export, there are inherent risk, and I use the same slide for you to manage how you can structure a facility, because by structuring also you can mitigate risk, because as I told you that for a housing loan you don't give a overdraft facility. Similarly, trade finances need a lot of structuring, and therefore this is a good way to learn structuring also under this particular header. Uh, Credit risk, now people who do import exports need money. At the same time, this is also called international trade. International trade also consists of various norms, or we call it Incoterms. So you have to adhere to international standards, practicing worldwide. Um, the first of all, to make it facilitate, I will tell you the type of credit we grant to import exports. We take a small example. We'll say that uh, your bank is A, and you are an importer. So I put initials I for you. So I bank, I is the customer, bank with Bank A in Sri Lanka, and I customer wants some goods to be imported from, we'll say, country, uh, different country other than Sri Lanka in world market. So we'll say he's trying to import motor spares from Japan. So in Japan, you have the exporter. So exporter is the starting with E. So I will put the customer E is the exporter, and he bank with his own country a bank. We call it Bank B. So I customer bank with Bank A in Sri Lanka, E customer bank with B in Japan. And now customer I wants to import some motor spare parts from Japan, and he contact his customer in Japan. We have abbreviated him E. So E will send a performer invoice. Now in that invoice, he will describe the goods he is going to export as per request made by customer I, and also the price, and also he will mention whether it will include insurance, freight, and the cost. So we call it CIF, cost, insurance, freight. Or he will mention customer will have to do his own insurance, then it will be cost and freight. Or if the freight also is to be imported by, it's only he will mention the cost. So I customer get the performer invoice, and that invoice the e customer states that he want a letter of credit established in his name by the customer I. So what I does is he bring the performer invoice to the bank and say I need to import these items from Japan, and my customer is E in Japan. He wished to establish a letter of credit, and in the performer invoice all the conditions will be laid down. He might say that these items require manufacturing period of 2 months. Then he will mention the port he will ship from, then the cost insurance rate separately. All that is being mentioned here, and he will say, so I will come with the performer invoice and ask the bank to establish a letter of credit. So once, now letter of credits also, there are two types of letter of credit. We call it LCS and LCU. LCS is letter of credit site, and LCU is letter of credit usage. By site LC, that means once the goods have been shipped and once the documents have been submitted to uh, his bank, that is the exporter will submit documents to his bank B. Bank B will send the documents to Sri Lanka, the bank A. Bank A will notify the customer saying your documents have come, you can take release. And at that point, they will have to pay the money, and we call it retire the bill. So that type of a letter of credit is called site. That means once the documents are presented, you need to pay. If e-customer in Japan wish to extend credit to the customer in Sri Lanka, he can opt to open request him to open a letter of usance. Letter of usance means once the good comes, customer get the opportunity. Customer in Sri Lanka, the importer will get the opportunity to take the documents from the bank without payment and clear the goods. But he will give undertaking to pay at a specified future date. So he will get credit for that particular period. So that type of letter of credit, we call it letter of credit usance. So there are two types of credit: letter of credit, letter of site, and letter of usage. So now here we'll see how we can relate this to credit risk. Opening a letter of credit in favor of a customer overseas, banks need to establish creditworthiness of your customer who is the importer. Now, how he does is, so you go through the same credit process, though its export LC doesn't involve transfer of money, but bank is giving 100% guarantee once the documents are presented on time that bank will pay. So bank is liable to pay once the documents are presented under letter of credit S, that is a letter of LCS, and if it is usance, to pay on a future date. So to do that, sometimes bank will request the customer to establish a letter of credit limit, and that's where the permanent facilities to importer will start. So he will if we get a limit by the limit can be established by evaluation and taking some securities or margins, and then under that limit he can open number of letter of credits once the letter of credit limit is being established. So we'll say importer I now comes to the bank and say, okay, I'm going to continuously import these items from Japan, and the maximum value at outstanding at a particular time will be, we'll say, 10 million. So he will request the bank to establish a letter of credit limit of 10 million. Now, under which we'll say he has opened the first letter of credit, we'll say for 1 million, and letter of credit will transfer the bank A the customer's bank A will transfer the letter of credit to bank B in Japan. Bank B will inform exporter saying that there is a letter of credit has been received from bank A in Sri Lanka of the customer I, and then E will have to actually process the order. Now, on Japanese side, once again, the processing the order requires sometimes money. So this customer, to process orders, he may request a facility. Now, once the process is done with we give him a credit facility, we call it packing credit line. And it will be a short-term loan, and that he will utilize to manufacture the goods which have been ordered under that letter of credit. Now, once the goods been manufactured and shipped, when he hand over documents in complete set, Bank B can pay the exporter the full value even before receiving money from Bank A by purchase of those documents. We call this facility called foreign bills purchase facility. So in our structure for the exporter, for the importer, we start with the letter of credit limit. For the exporter, we may need to start with the letter of foreign bills purchase limit, because at a time there can be several foreign bills which have been purchased, not been paid at a particular time. You may have done multiple imports, exports, and therefore all the bills have been purchased by the bank and it will remain there. So on the exporter side, we establish our first limit called FBP, or foreign bills purchase, under which that limit you can establish a packing credit line. So we call this within which limits. So when you are structure exporter, you establish a foreign bills purchase limit, and within which you establish a packing credit limit. On the importer, on the other hand, now we have established a letter of credit limit. Once the goods come, he need to pay, but he will tell the bank, I will pay only after selling these goods. Then he need a facility. That facility will be a short-term loan, and we term it as a revolving import loan. In abbreviation, we give RIL. So we open him originally a letter of credit limit, then under which letters of credits are established, and once the document come, if we need a facility to retire those bills, we give him a revolving import loan. So our structure will be, for the importer will be letter of credit limit, within which we give a revolving import limit. Our structure for the exporter will be foreign bills purchase limit, within which we give him a packing credit line. So I hope you understand. Actually, it will be much better for me if I can draw something and explain you further how this works. But we are doing online. Sometimes we may not be able to counter. But if you have any doubts, please tell me. Then I can further explain until you clear your doubts. Now, those are letter of credit limit and letter of usance limits. Now, there are other ways import and export can exchange goods. If the exporter says, no, I need money in advance before I do manufacturing, then we call that term, we call it advance payment. So once the performer invoice comes, he take that to the bank and say, this customer wants advance payment. Now advance payment has to be sent even before goods have been started manufacturing. So customer I things that exporter will oblige to his request, as in the perform invoice, without any doubt, he will opt to take that risk by paying him in advance. So he will tell the bank, my customer need payment in advance. So bank can actually, within the revolving import loan what we have been established earlier, you can have a short-term loan to pay that advance. So there's another additional structure coming into the importer in case if we ask for advance payment. So they give a short-term loan, and then customer will bank will prepare a telegraphic transfer in the customer's name and send direct to the bank there, and he will receive money. That is called advance payment. Advance payment, there's a risk to the importer. If your customer is an importer, he's going to depart with money even before receiving goods. So, in case the exporter, his supplier, uh, decide not to send the goods, and then there will be that short-term loan what you gave to pay advance payment will go into non-performing advance. So therefore, that risk is there. At the same time, um, you order a car by payment of advance payment, and by the time uh, the car is to be exported from Japan, there will be regulation in Sri Lanka, the ban of imports. What will happen again? The importer will have problems because he has already departed money, and now the regulation doesn't allow him to bring the item which he ordered. So at the same time, uh, if the exporter's country also has certain rules of exporting certain items, a ban on used cars or whatever, then this risk will come to the importer. Now we also have certain other methods of doing this transaction. We call them collection. Now, importer in Sri Lanka will request the exporter in Japan to send the item, ship the item and send the documents through his bank to the Sri Lankan bank, which is Bank A. Then the Bank A will advise your customer importer I. Certain documents have come on collection, and you need to pay the money in order to collect the documents for you to clear the goods. We call it uh, delivery against payment. We call it DP documents. So when that occurs, risk will pass on to the exporter because he has departed with the goods without receiving money or any undertaking from the um, importer payment. Only he has sent the goods and awaiting for importer to collect. Only he is avoiding risk is by only DP terms means once the goods goes to the Bank A in Sri Lanka, they will only release these documents to importer by getting payments. So when the bank gets payment, it will pass on to Bank B in Japan. Bank B will give money to exporter E. Now we'll say this customer has got item motor spare parts under letter of under DP terms. Goods have come, goods are in the harbor, and the bank has got the documents. Now what happened? Our customer import I will have to pay. To pay now, if this country has a foreign exchange problem, uh, he will have to actually bank will say no, we cannot grant you foreign exchange to clear this import, what will happen? This will lie in the harbor for quite some time. Then also the customer will have to pay demurrage. All that risk will be there, and we call this sometimes a country risk. So exchange controls are in different countries. Now we also have this problem, and if you opt to that DP term facility, and if importer find it's difficult to find foreign exchange, exporter will get a risk, and if the exporter has got a backing credit line from his bank B, bank B will have a NPA position. So these are the risks in this type of um, uh, letter of collection, the DP terms. DP terms can get extended further by giving um, letter of acceptance. DA terms. Letter of acceptance means they will accept the documents but not pay immediately, but at a future date like LCU. So thereby the importer will get credit facilities. So we looked at international trade in three ways. The letter of credit side, letter of credit usance, then we call it advance payment. Then we also looked at delivery against payment, delivery against acceptance. So these are the term of credit which the importer and exporter will agree to do their transactions. In between, I told you how the structuring will be done. Then also I looked at few risks like country risk. Certain terms will also allow like advance payment. The importer take higher risk by departing with money. There is also the another exporter will face another problem. We call it open account. That means exporter will send the goods, and goods will reach the customer, the importer's country. Documents will pass on to his B, and then those documents will be either directly sent to the exporter or to the bank to pay. If that particular time the importing country has certain country laws or importer himself is bankrupt, goods will be in the hands of the importer, whereas money has not come to the exporter. This is one of the example which I can give you is most Sri Lankan teas are sent on this open account. So our exporters of tea take that risk by sending the goods on open account, relying that the exporter, the importer in that country will pay them. So to avoid that, there are certain methods they follow. They establish a company in that particular country, and then they send to that particular company in importer's country. Then from there, they do the distribution. So there are methods of to avoid. On top of this, we also have kind of fraud risk situation here. You know, the fraudulent activity in this also will take place. You know, duplication of documents, then various advance payment methods what we use also can be fraudulent, and the pro forma invoice sometimes it is made in, by the importer himself, so there's no guarantee from exporter sending the same item, so sometimes you get rubbish in the container. So all these are kind of fraudulent activities that can take place in this international trade. So bank also may need to play a advisory role to your customer. So banker's role is advisory on method of payment, status report, country report, market conditions, the exchange rate, and what terms they should apply in doing either LC site or LC users or collection DP or DA or advance payment or open account has to be advised, risk has to be informed to the customer, either importer or exporter, so that the bank will play a kind of an advisory role on this. So you need to know this particular international trade or trade finance in particular, because if you when you handle corporate clients, mostly they engage in this type of trade. With that, we have done the credit management side. That means on the business side, what you learn how to avoid credit risk is being now done if you are in the business unit. But if you are a staff member who is attached to risk management department also have different sections. We call it credit market operations mainly, and sometimes IT. So these separate departments also will receive, they will receive the appraisal form, credit appraisal form, but it's been prepared by business unit uh, for kind of a approval of facilities. So that is where counterparty credit risk is concerned. So counterparty credit risk uh, need now need dual approval or dual recommendation before it be granted. So business side also look at the proposal in detail, and then they do a credit appraisal form and send to uh, credit risk department, and risk department also need to give a kind of a recommendation or risk assessment and certain recommendations before we finally grant the facility. So now we have looked in very detail what we have done in the business unit. So now we'll think that your appraisal form has gone to risk management department, and we will see what does the risk management do with that, because if you are a staff member in the risk management department, there are certain functions you need to do with the appraisal form. You also can't take time, because on the other side the customer is waiting for approval to get facility. So you need to actually manage your time and quickly attend to this particular appraisal, apart from rest some of the other functions you do at the credit risk department. But the appraisal form need to go faster. uh, Whether you recommend or decline, it has to reach the business unit faster. So now we are going to look at what you do in the risk management department. So it is actually the same coin. There are two sides. We have looked at the heads. Now heads are the credit management. Now we are going to look at the tail. Um, though it is the same coin, there are two different functions or different description will carry in the credit risk management department, which is a back office function, and there is once again there is a process there. They have a lot of other work other than looking at the credit appraiser. So we have different people who are actually looking at this. They need to understand the credit strategy of the bank. So credit strategy means, I told you that if the if you put all the money in the all the eggs in one basket, like making without diversified credit, you concentrate on one type of credit, and if that fails, you will have a once again the concentration risk will apply, and then you will have a problem. Uh, so they need to have a strategy. What is their target market is. So they will understand the different type of industries in the economic environment, and they will prepare We sometimes we call it lending guidelines to different divisions, industries, and they will also request the business unit to target certain segment of industries which are lucrative and bank will derive a lot of profits. They also look at credit risk policy. They will also look at they will also involve in formulation of credit procedure manual. They will also publish lending guidelines. So these are very important three documents. What they do, credit risk policy is a policy which has been approved by board of directors. In that, they will identify the market, the target market. Then they will, in the procedure manual, they will tell you how you process uh, from entire credit process will be completely described in under this procedure manual. Um, Lending guidelines are for different type of credit lines. They will issue different guidelines, so that will be helpful for the business unit. Then also they will establish credit risk management structure. That means, in banks, or in a branch, if a customer comes to you with a proposal, if you are a credit officer, he will first discuss the proposal with you, and you will do the initial evaluation. You will inform your manager that I have processed this credit appraisal form for this particular client. If manager has the authority to approve this, he can sign and approve and disburse facilities. But mostly larger credit uh, authorization limits will be differ from one management staff to the other. So if the branch manager cannot approve this, the next level will be a regional manager. So if the regional manager can't approve this, he will refer to um, uh, head of credit of that bank. Then head of credit limits also limited to approve such. He will refer this to CEO or internal credit committee. If the limits of all these are not sufficient to approve that facility, then it will go to the board of directors. So the structure of the credit risk management um, will be done by this credit risk management unit. They will identify the people who are with the ability, who should be actually analyzing credit, who should be approving credit, as for what limit they can do it, and the delegated authority levels will also will be recommended by the credit risk management unit. So introduction of regular validation of internal rating system. Now, most of the banks have this. So before they give credit, they put the information into a computer system in the bank. We call it rating system. Rating system is a very important uh, tool what we have to evaluate a customer's creditworthiness. Now, rating system works when we discuss the retail credit. I told you the scoring method will give certain points. Similarly, on a we'll say a corporate client, you do financial analysis, you do um, qualitative analysis. Both um, there will be various items you discuss. Under financial risk, you will discuss its profitability, its liquidity, its uh, solvency. All that will be discussed, and certain ratios we will create. And once those ratios are acceptable to the bank, they will have the highest marks for that. So similarly, there will be a lot of validation points of the rating system. Now, introduction and regular validation will be done by the credit risk department of this particular system. So the system one day will have, you should be able to actually put your information to this system and decide the facility. Establish credit control process. prudent limits for industry, large exposure, single or related party, and connected party borrowers. We will be discussing these items when we move forward, because certain control processes also being come under the purview of credit risk management, and which not only sending you appraisal back with recommendation is not only the function of the credit risk department. There are other functions like setting limits for certain industries, uh, check whether regulatory requirements are met or adhered in your proposal. Also part of um, credit risk management process. So managing credit concentration and specialized portfolio is kind of a method we they follow to manage concentration risk. So to continue that, they will review concentrations. They will also look at collaterals. They will look at ratings of the customer. They will look at what interest rate you have charged. And they will also look at, if it goes to non-performing, how you have done your provisioning. So but the idea is to actually the business unit to have a quality credit portfolio. So credit risk management support to do that, because that's your final aim. They will also look at what is happening in the market. Um, we call it environment, economic environment, with their past track record. Now, say if there is a problem of terrorist attack or disturbance in the country, they know that the first thing which will happen is the tourism sector will suffer, and then we will have a lot of NPAs. At that particular time, they have some futuristic knowledge of what's going to happen. They will immediately advise the bank that these sort of things may occur, and as a result, our credit portfolio can get affected. We call this kind of a stress testing, or we call it scenario analysis, in order to forecast um, what could be the action we need to take in case of a unforeseen events that is happening in the economic environment. So these are some of the functions of the credit risk management unit. Now, once again, I'm going to compare the credit risk management versus credit management in the form of a risk management process. Now, if you look at the left side of, or your right, your left side of this screen, you will see that is credit risk management. How they manage risk is, it's a process. We call it risk is managed through identification, measurement, and responding, either monitoring, control, and report. This is the process involved in risk management. Now, we say in order to manage risk, you need to identify the risks. Then you need to actually measure whether that risk is acceptable, because if any business proposal, there will be risks. When you identify, and if you're going to avoid all that, you will be out of business. So what you need to is, you need to measure whether we could mitigate those risks by taking collateral, taking covenant, and if that measurement is not very unhealthy, or it's not very big for you to undertake, you do accept or avoid. If it is, your risk is too big for you to handle, what you need is you avoid. Avoid in the sense you decline the facility in the other side. Respond here, accept means you approve the facility. Thereafter approving facility, you just can't wait. You need to monitor how the loan is progressing, the repayments are good. If not, certain times you may have to put controls. controls such as no further advances, uh, securities not to be released until full payment, that controls you can do. Then finally, you also need to report to your management what's happening in the your loan portfolio. On the business side, when we look at evaluation, what we are doing is the business development. You take all the documents. You take loan origination documents, application forms. Then there itself you will identify the type of risk, his purpose, whether it is valid purpose for you to lend. All that you do under kind of a business development activity. Then you bring the customer to evaluation stage. That is where you start writing your appraisal form. I told you evaluation equal on the credit risk management to kind of a measurement stage. So evaluation, you do financial evaluation, you do qualitative evaluation, then you also can do credit rating on a system to see whether he is credit worthy. So if he is credit worthy, what we do is we approve the facility. Um, we also call it, we execute the facility. Um, and execution, before execution or disbursement, we need to take the collateral. Then monitoring is done by your credit administration, where they will record all collaterals, they will put limits, and they will do renewals of facilities once in 3 months, or once in 6 months, or once in year. Then annually, also we do a review of facilities. And if facilities are not being paid, you will not allow further facilities, or you will recall the facilities what you have already granted, and uh, make sure that you will not have a NPA. Now, all these things you also need to report to your management, and by way of a management information system. So the process looks similar. Uh, Only the certain terms what we have used in credit risk management and credit management differs. So the process is similar in comparison. Um, so what we are now looking at is the credit. We have looked into this area, the credit management process we have gone through. So I'm going to touch on uh, yes, Manuranga, you have raised your hand. You can unmute your mic and speak. Yes, Manuranga, do you have any question?
So that is regarding that.
No, you got please unmute your mic and get close to your mic. I can't hear. You okay so far? You can put your question on the chat box. Then during the break,
So can you hear
I
me?
will take up. You can put. Yeah, now I can hear. Yes.
This is this question regarding that in advance payment, when we are doing advance payments, you have
Yeah,
tell we have to grant STL for the specific facilities. Instead of
yeah,
STL facilities, can't we grant IFL facilities?
you can. Yeah, I mentioned the type of a short-term facility. It can be uh, even within RIL limit, you can approve any type of facility to this customer because it's for the import purposes.
Thank you,
Okay,
sir. Thank you, sir.
right. So now on the risk management side, the first step is identification. So to do identification, the people in the risk management department also must have certain other knowledge, because on your credit management side, they look at the documents, the application form, the information what the customer provide are the criteria, because they are looking at very micro level only relating to the customer. Whereas if you are in the risk management unit, you also need to know what is the bank's credit strategy. That means which type of industries or product where bank is, more efficient or uh, advantageous for us to, lend. So if our strategy is understood mainly by the credit risk management department, uh, then they also need to understand the economic, political, and social and technological environment it operates. Because sometimes, if you are in the business unit, you have no time to actually look at into how the country is doing. Uh, you mainly concentrate on the customer, but risk identification can go a little further with the input of risk management, because their identification is related to the entire economic environment. So when a proposal comes, they will first see uh, whether this is um, have more risk due to current economic environment, or whether it is based on our strategic intent or strategic objectives. For these reasons, banks generally have different guidelines for them to work. They call it risk appetite. Risk appetite is kind of a willingness to lend to a certain uh, industry or particular product. So generally, uh, risk appetite is decided based on the risk policy manual what you have recommended from the credit risk department to the board of directors. Sometimes it will give industry limits. We'll say if the tourism industry is not doing well, and if your total exposure at particular time, we'll say 6% of total loans, and if you think that this is risky, you can actually reduce your appetite for tourism. Then what you do is you will do a recommendation to bring down the total lending to tourism by the bank from 6 to 5%. So that way you discourage facilities coming from that particular sector. So whereas certain, now say for trade, import, export, if bank wants to actually enhance the credit facilities given to exporters, then they must set the appetite little higher than that. So they must actually target exporters and do canvas. Risk tolerance also another aspect. Now say these are certain limits. Now I told you when you build the structure, you give certain limits to your staff who can approve loans. So those are actually tolerance limit. Sometimes if you are in specialized credit, uh, from the business unit, though it is within the approved limits, sometimes the duration, now say duration of opening LC letter of sight maybe for 3 months, some customers will come and ask, manufacturing time take longer, make this letter of credit valid for 6 months. Then your original approval on your delegated authority say 3 months, then you need to actually pass that on to a higher approving authority, because your tolerance limit has been surpassed. So similarly, you also you must know the content of credit standard policy manual, credit procedure manual, lending guide, identification of a customer. So I think credit staff, the staff in the then we go into another important area, measurement. Now, I told you that on your evaluation, um, what you do is you will see whether your customer is creditworthy. Now, credit risk people also have ways to verify through a kind of a mechanical system uh, how trustworthy or how good is your borrower or how risky is your borrower in their terms. And they also want to know if he defaults, how much bank will be exposed, and if default occurs, how can they recover this money, and to avoid having a default situation or NPA, what mitigation they can take. So to do that, we actually follow a simple formula. Actually, this need to be uh, explained in a, using actually a system. But I will tell you the basics. What we are looking at this equation, what we are looking at is EL. EL stand for expected loss. So you can write down expected loss is equal to probability of default. PD stand for probability of default. Then into EAD stand for exposure at default. EAD. Then into the PDG you can cut. You can write LGD, loss given default. Right. So equation stand for expected loss is equal to probability of default into exposure at default into loss given default. So we apply this formula in a system and arrive at the expected loss. To do this system, you need to have actually 5 years data of different credit rating customers. Now say, again, I want to tell you how the rating is done. Internal rating, what we give is each validation point we give a mark. Now say, for example, if customers debt equity, bank would like to have 3:1 in a project account. We'll say 1:1 in a normal account where customer bring 50%, bank is giving 50%. We give different points. Now say if customer brings 50% and banks give 50%, we are very happy because he has put a lot of money. So debt equity is 1:1. We'll give 100 marks on that particular validation points. If customer brings 25% and we put 75%, we'll give 50 marks. If customer brings 10% and we put 90, then we'll give 25 marks. If customer wants to do only using bank funds, that means 100% loan is given by the bank and his contribution is nil, only is just managed, then we'll give 0 marks. So when you add up, similarly, you have these validation points like that I did for debt equity, you can do it for solvency, you can do for his product, his market share, you can do various things. Sometimes in a corporate customer, you will have about 50 or 60 validation points. And each of these points, you carry four lines of marks, 100, 50, 25, and 0. And each point, when you put their data into the system, they will give the marks. We'll say the total marks, the aggregate of total marks of a customer will come to, we'll say, 95, between 90 and 100. We give him a triple A customer, like Fitch, they give banks certain ratings. Some banks are triple A, some banks double A, some banks single A. Those also been done similar rating module description. So they are credit rating agencies. They also do a kind of a rating of a customer. So similarly, banks, what we are doing, we are also doing a rating of the customer. So our internal rating model, the word EAD stands for exposure at default. Okay, exposure at default. So I'm trying to get into how do we do this formula on a manual basis. So we'll say last 5 years we have done rating for your customers. And we'll take, for example, you have to write down this. I will give. You have a customer whose rating is single A. That means you have a customer who has single A. But in the past, you have given many single A customers similar type of facility. We'll say you give a customer single A loan payable 5 years, right? And then you monitor these facilities over last 5 years and see how many single A customers have defaulted and at what stage. For example, we'll say single A customer who has taken a 1 million loan, we'll take, for example, a million, and most of the customers have defaulted. 1% of customers have defaulted after the third year. After 3 years, they have repaid. In between, there are, business failures. You don't have even 1%. 1% of non-performing will occur after the 3 year. So when 3 years repayment has been already paid, now when we start the 4th year, they default. And 1% of your all single A rated customers default after you get average of the past. 1% of NPA will occur after the 3rd year. Now this, we cannot just measure, you need to actually put your graph and see, put all your customers and see their duration of repayment and at what point they have defaulted. So this you need a system. So we'll say, for example, we'll take a customer, now he's single A. Based on our past experience, all single A customers who have taken 5-year loans have 1% default after 3 years. So probability default is 1%, right? PD now stands for 1% because that's the NPA. So after 3 years, the NP is 1%. That is our probability of default. EAD we'll take a 1 million facility. He has paid, say, equal statement of 5 years, you divide 1 million. So each year he will be paying 200,000. So first year he has paid 200,000, second year he has paid 200,000, third year he has paid 200,000. So now our next item in our equation is EAD, exposure at default. Now 1% of customers will default at the fourth year, and that year exposure at default will be 1 million minus 600,000 already repaid. So our exposure at default is 400,000. This particular customer. So 1%, 1 into 400. So if you don't have security, we will lose this money because he has defaulted. Our expected loss will be 400. Now, our LGD, the next line, is not PDG. I told you to cut it and write LGD. LGD stand for exposure at default minus collateral. So, if we have taken security, if we have not taken security, we are not taking LGD, so our loss will be 400. If you give a customer single A 5-year loan on clean basis, and we know the probability of default is 1%, after third year, if we default, we will lose 400,000. But that will be our expected loss. But you know, when you give a loan, we take a collateral. Sometimes this collateral has a value. So if we'll say for a customer, when we give 1 million, we have taken the collateral worth 1 million. But at the time of his default, his exposure at default is 400. So 400 minus his 1 million, which is LGD, stand minus 600. That is 400 minus 1 million equal to minus 600. So our probability of default is 1%. 400 is our outstanding. We have a situation in a minus situation. So we don't have an expected loss because our securities will cover that 400,000. As a result, we also will have sufficient security, 600,000 in excess security to deal with this customer. Now, if you give clean, we lose 400,000. But we'll say you have taken a security worth only 400,000. So 400 minus 400 becomes 0. LGD 400 minus 4. LGD stand for exposure at default. That is 400. Your security also 400. Then it will become 0. So 1 into 400 into 0 also equals 0. So you have 400,000 worth of security. Your expected loss again will be nil. So this method we will use to predict based on your internal rating methods whether this customer is going to create a problem for us in the future. Because in the past track records, which says single A customers have a 1% probability of default after 3 years. So you will make sure if you get a customer of single A for a 5-year loan, you will at least must take 400,000 worth of security before giving the facility. So the risk is measured by this particular equation, and then to mitigate, you take sufficient collateral to avoid bank is suffering a loss. So this method is being used by the risk management unit, but I think some have already done this into their system, and the system will generate based on the credit rating of the customer. So it's a kind of a measurement they use. Risk response and approval is the next part, like you approve the facility in your business unit. generally they will look at various guidelines before they do the recommendation of the customer. Now, they will look into certain regulatory requirements also before approving facilities. Some of the regulation requirement, one I will take as a single borrow limit. Single borrow limit is a limit stated by the Central Bank of Sri Lanka, and generally we call this maximum amount of accommodation. Now, maximum amount of accommodation, or MAA, is in our own language we say single borrow limit. That means a single customer, the amount, maximum amount he can borrow from a bank. If you are a single borrower or a group of companies, this particular limit is given. They say facilities to single borrower group of borrowers, net of collateral covered cash, gold, government, and CBSL securities or guarantees should not exceed 30% and 33% of capital respectively. Now I want you to go back to that day we created a balance sheet. Now, you remember I put our balance sheet total assets 100 billion. You also, on our current asset side, we look at cash, we looked at investments, we look at loans and advances. If I remember correct, I put some values to it. I put current assets, total current assets 90. Then I said loans and advances 69. Because 21 liquid assets required, I deduct 21 from the 90 and arrived at 69. Then on the liability side, we looked at current liabilities, that is your customer deposits. We look at long-term liabilities, which are your debentures. Then we look at equity. Now, equity is the bank's capital. Now, what central bank says is you should not give a customer single customer more than 30% of your capital. If it is a group of companies or group of customers asking for single facility, you should not exceed 33%. However, this restriction doesn't apply to the government of Sri Lanka, CPC, which is very much in headline these days, Ceylon Petroleum Corporation, and CEB, also very much in headlines, Ceylon Electricity Board, because these limits, if you apply to them, they can't do any business, because CPC need a lot of money to import oil. CEB need a lot of money to supply electricity on collection basis, some to government, sometime until we pay our bills. So they need a lot of money, and as a result, they borrow huge amounts from banks. And if we apply this single borrow limits to them, they cannot be in business. So that restriction is there. Now, I take a small example and say, as for our requirement, as for our balance sheet, our capital was 10 billion. Now we'll say you have two customers. You can write down customer A and customer B. Right? You can take a piece of paper, write A and B. Both the customers requesting a facility of 4 billion. So their requirement is 4 billion by customer A and 4 billion by customer B. So the loan amount is 4 billion. The customer A has a fixed deposit of $500 million, that is 500 million, in your bank, which is willing to give as collateral. And he says, I am a AAA customer, I am a good corporate customer, I cannot provide any more collateral to you and give me my facility on clean basis. Only I will keep the 500 million, which is in the bank as a fixed deposit. bank, the customer B is not a triple A customer. He may be the single A customer. He doesn't have deposits. He has got some guarantees issued by the government to do this project. The guarantees in his favor are 500 million. Again, 0.5 billion. So he says, I'm going to give those guarantees, assign those guarantees to the bank. Plus, I have property worth 5 billion rupees, which I will keep you as collateral. So customer A wants 4 billion. Customer B wants 4 billion. Customer A give a security of 0.5 billion, that is 500 million. Customer A give 0.5 billion. Customer B give 0.5 guarantee assignment and a 5 billion worth of property. Now, I want to ask, to which customer do you like to lend? If I write down, both customers want the same amount. One is a triple A customer, one is a single A customer. Triple A customer only provide you only 0.5 billion collateral, whereas your B customer provide 0.5 billion guarantees from the central bank and also another 5 billion worth of a collateral by way of a property. To whom do you like to give?
B.
B. Any more answers? You can try your luck. I'm not going to penalize. Now here what I'm trying to explain to you is a different concept. I'm trying to explain to you is maximum amount of accommodation that can be granted to a customer. Now say our banks, look at our original balance sheet, our capital is 10 billion. So maximum to a customer we can grant is only 30%. So which is 3 billion. Now both of the customers are asking 4 billion. So both of them are disqualified to get this facility because it exceeds the single borrow limit. Now there's a component where collateral comes. This collateral deduction is allowed if the collateral is given in cash, gold, or government securities or guarantees. Now customer A gives us a 0.5 billion cash or deposits. So you deduct 0.5 billion, still his facility is 3.5 billion, which also exceed our limit of 3 billion because 30% of 10 billion is 3%, 30%. Then customer B give a collateral. The qualifying collateral is only cash, gold, and government securities or guarantees. He gives a guarantee. So you deduct that guarantee 0.5, his exposure also 3.5 billion. But he give a property. The property is not a qualified collateral in this particular situation. Your answer in the sense of a banker who is trying to safeguard the bank's interest by way of doing business is right. But when you apply the maximum amount of accommodation or the single borrow limit regulation, both of them are not qualified under that criteria. So none of them can have this facility. Now I am going to go a little further on this because I got a very good answer and I'm very happy that at least someone has the guts to tell me some business sense into our particular presentation. Your business sense is mainly you think we have a collateral, we have a customer, and probably his project is viable, and that's why government has given him a contract. So you have 0.5 billion guarantees also in your place. So now going into customer A or B is the bank's business. If bank thinks that they would to give both facilities, still they can do it. How can they do it? Violating this maximum amount of accommodation or the single borrow limit. Now this will be a hindrance for you to progress in your lending because government regulations are there. But nowadays bankers are a little most smarter than that. So they go on finding other ways of lending to good customers in order to earn money. Tell me, someone can tell me how they can overcome this situation of a single borrow limit.
You will have to ask the customer to get central bank approval on that.
Ask the customer to take approval from the central bank.
Yes, sir.
Central bank will not give approval because they have put this regulation valid for all the banks and to all the type of customers other than government of Sri Lanka, CPC and CEB. So they may not give. But banks have a method of doing it. Banks, what they do is they have a method called syndication. That means your single borrow limit is here is 3 billion. Therefore, you can go up to only 3 billion. So what a bank can ask is, they can ask two other banks, two other commercial banks to join you in giving this money to this customer, because you do the evaluation and you found the both customers are their projects are viable, the repayment is good, and AAA customers generally undoubted repayment, single A customer who has adequate collateral. So in order to do that, what you do is you call up two banks or three banks, whatever, and ask whether they would like to participate in a syndication. In a syndication means you become a leader who does evaluation of this facility. Since you have a requirement of adhering to single borrow limit, you cannot lend more than 3 billion. So you will say, I will undertake 2 billion, and there's another 2 billion to be lent. If bank A or bank B, who is going to participate as participating banks, they can take up 1 billion each, and together they can give the loan to these customers. We call them syndication loans. So there is an option to to overcome this, but most of the good customers, especially blue chip corporates, don't like these kind of arrangements, because then they are subject to answering lead bank, and sometimes the other participating banks also ask questions. So they will sometimes come to you before they open account and ask what is your single borrow limit, because if they have intent to borrow large amounts, they don't want that single borrow limit requirement to be a hindrance for their future facilities. So this is one of the regulatory. So your credit risk department will see, moment you submit the evaluation paper, they will see whether this is falling within single borrow limit. And also sometimes they have informed already the business unit, especially large facilities, they will request the business unit to put a remark saying they know what is the single borrow limit, so they need to write in the appraisal form, this falls within the single borrow limit of the bank. So that conditions will be rechecked by your credit risk department. They also check certain facilities of related party transactions. Now, I will go to what is related party transactions. Who are the related parties? If the bank is, most of the banks have their subsidiaries, sometimes they have a leasing company as a subsidiary, they have actually this, building development company, also construction company and subsidiary, because some of the banks have these, towers of their own. And what they do is they will form another company, a subsidiary company, and the entire tower will be managed by that particular company, and the bank also pay rent for the space what they occupy. So these subsidiaries also need money, and so they come under a related party. Subsidiaries of banks are called related party. Any director of a bank or key management personnel, we call it KMP. They are your corporate management, uh, your CEO, your deputy general managers, your assistant general managers sometimes are called key management personnel. A close relation of the director or key management person, that means their spouses or wives also become related party. A shareholder owning a material interest in the bank. The material interest is generally we call it 10%. If a shareholder has 10% shares of the bank, he also become a related party, because then he can influence a lot in order to get his facility. Similarly, your director can be a director of another particular company. We'll say you have a single director whose company has 10% shares of your bank. That particular company, he also a director there. That will say company A has 10% of bank B. Now company A appoint a director from the company and ask him to become a director of the bank also. So he become a related party. Now company A has another 3 subsidiaries, right? We'll say one subsidiary, we'll call them CDE. C is 100% subsidiary of company A. What will happen is, if C wants to borrow money, C also become a related party. B will say 50%. 50% also substantial, more than 10%. So B also become a related party. If they have another company C, which will say 5% interest, the CDE, E is 5%, then E is not a related party. So what we are trying to establish, who is the related party. Why we are doing this is, there is a regulation by the central bank. Related party, they think there is a co-principle here. So the principle is, if you are a director of a bank or a key management personnel, you know very well that any of them come to you for a facility, you don't ask all those 100 questions you ask from a normal customer, because their influence and they are actually owners of the system. So they have a special advantage. So you will just process the facility in quick possible manner, and sometimes even might not ask the collateral required. So for this reason, central bank wants certain regulations put on this related party. Let me ask a small funny question. Probably you might can answer. Tell me what is the easiest ways to rob a bank? Someone can tell me. This is not a related subject, but we have been lecturing so long. We need to have kind of a little bit of humor to understand this, because on this subject, I remember something so that I asked you a question. Can anyone tell me what is the easiest way to rob a bank? Work in a bank. Very good. Yeah, you have access to various systems, um, but you sign kind of most of the banks, they sign a kind of indemnity that they will not divulge information to outside. They will work according to the ethics and the uh, certain terms and conditions what you are given under your employment. So those things might restrict you just because you work in a bank. Uh, the answer generally in this is a little bit funny, but they say the best way to rob a bank is to become a director of a bank. Or because directors, they don't participate in your management, they don't work like you, but they only attend one or two meetings in the bank. And what happened is they are related to various other companies whom they can use their influence for them to borrow money from you and then default. And once that default comes, um, you know, uh, you and your recovery staff members will be reluctant to, pursue those customers because there's some interest of a director. Now, to avoid that, central bank has put the directors, any facility what is been director concerned, has to be approved by the board of directors themselves with a two-third majority. That means we'll say you have 10 directors in the bank. One director is requesting, we'll say you have 11 directors in the bank. One director is requesting a facility. Then he will have to go out of the boardroom and allow other 10 directors to decide whether the facility can be approved. Out of that uh, two-third, that is about 7 directors must approve this facility in order for the director's facility to be approved. So it's another control measure where other directors become liable on a facility is given to a fellow director. Now we also see they also need certain securities. See, when you take securities, central bank also apply certain conditions, much more stricter conditions when giving facilities to your key management personnel and directors. If you are taking security, they can have cash security. They can only take 90% of cash value. They can take only 75% of the surrender value of their life policies. You see, they can take only 60% of land. Now, I know some of the customers can enjoy up to about 75%, but the directors, they have put for 60%. If they are taking money against shares, they can take only 50% of the market value. If the stock mortgage is being considered as collateral, they can take only 30%. Pledge loans, they must have stock worth about 40% for them to borrow money. So you see, related party transaction is also another area you have to look into when you are giving facility. Now, we go into another requirement by the regulator. We call it equity capital. Now, you have heard this word, capital adequacy ratio of a bank. That means bank will take the assets and they do a risk weight of assets. Now, say if you have a customer who has borrowed money against a cash deposit of his own, there's no risk because you can set off that facility in case he default. Then what you allocate that customer's risk weight is 0. If you have a customer who has given 50% collateral to you, and that collateral is of a qualifying collateral, like 50% value of cash to the total facility, his rate is 50%. Similarly, there is a committee by the um, international committee by the World Bank, or we call it Banks for International Settlement. World Bank, they have set up a committee called Basel Committee. Actually, Basel is a town in Switzerland. This committee met in this particular town, so they named the committee as a Basel Committee. And banks, this is a international law. Actually, it's a regulation by International World Bank, and as a result, what happened is they have come up with some accords. And those accords are called Basel Accords. Now, these accords are coming from 2000 in 98, then 2004 the Basel II. Now actually the Basel III also has come. So I'll little explain to you what is this Basel is. This is the Basel II. It has 3 pillars or 3 sections. In this first section, they want banks to maintain a minimum capital. We call it capital adequacy ratio. Now, capital adequacy ratio is being calculated for your credit risk, market risk, and operational risk. What they do is there are certain standards which I don't want to go into very much details because it's not in our syllabus, but to make understand what is equity capital. Say minimum capital requirement. So we do a risk weight of all the loans. We do a risk weight of all assets of the bank, and we'll see compared to your capital, what is the percentage. Now we'll say your equity is 10 and your risk weighted assets are 100, then your capital adequacy ratio is 10%. If you have risk weighted assets 200, and if you have only 10 capital, then your capital adequacy is 5%. So this now the regulation under Basel II was for you to have 10% capital adequacy ratio. However, now we have gone into Basel III. Now Basel III, your capital adequacy ratio now stands at 14%, provided your bank has more than 500 billion asset base. Less than that, they have allowed to keep at 12%. So that is the current requirement, and generally this requirement is checked mainly to see your equity capital. What happened is, now I'm going back to our maximum amount of accommodation customer. I had 2 customers, A and B. You may have wrote down there. Both are asking 4 billion facilities, and finally you can't give both. One has given collateral cash, so the net exposure for him is 3.5. The other one has given a guarantee. Net exposure is 3.5. So first one is a single A customer. First one is a triple A customer. Second B is a single A customer. Actually, 3.5 million is exposed if we give that facility to customer A. whereas we have no security. But his rating is triple A. Now, under this requirement of internal rating, if you give a triple A customer, he actually has a very good track record, and all the facilities that have been presented to him or given to him in the past has been repaid. So, taking into consideration, the Basel committee has said that risk-weight asset calculation, triple A customers, if your internal rating is accepted, triple A customers carry only 20% risk weight. Now, we'll say we have given a syndication loan and your exposure to this customer, we say you gave 4 million, whereas 2 billion came from you and 2 billion given by two other banks. So this 2 billion you have given to a triple A customer, the exposure for risk weight is only 2 billion into 20%. Whereas your customer B, though he give a property, is a single A customer. The property value is not being considered as reduction of the exposure. So even if you have got two syndication partners, your exposure is 2 billion, and a single A customer risk weight is 100% despite there is other securities. If securities are cash, gold, government and other guarantees, then you can deduct. If not, even though you have property mortgage, that is not being considered as in your risk weight calculation. So they look at the rating of the customer. So single A customer has 100%. So your entire 2 billion, you have to set aside for your capital for this equity capital calculation. So 2 billion into 14%, you have to keep out of your capital in order to give this facility. Whereas the customer A is enjoying, he is having a rating of triple A, his risk weight is 20%. So 20% of 2 billion only you have to keep as capital in customer A. This is what you call equity capital. Risk management generally look at equity capital in order to preserve capital adequacy requirements. This is mainly applicable to banks which doesn't have enough capital to show for regulatory requirement of 14%. So they pick and choose facilities based on rating of customers in order to avoid non-compliance of capital adequacy. So these three are regulatory requirements which generally your risk department do it. Your risk department also generally look at your interest in suspense calculation and your provision calculations. I skipped that today because main reason is now new regulation has come there, because earlier regulation is based on duration you calculate the provisions. Now we call it impairment under the IFRS, International Financial Standard Reporting System, and that is mainly based on your cash flow expected from a customer. So that I'll skip because that doesn't come into effect. We have looked at the related parties. We looked at the Basel. Now, those are actually the items when your appraisal form get to risk department, they also go through all what we have done, how we have calculated the financial ratios, how we have done the evaluation of qualitative aspects, how we have done the rating of the customer. They looked at all that, and apart from that, they look at the single borrow limit, they look at the equity capital, they look at whether this customer is a related party, all those have been done by the risk department. So if they also are happy and they think risk is acceptable, the risk department also will add recommendation to your uh, credit appraisal form, and then the facility will be jointly approved, and then customer can enjoy the facility. And thereafter, actually, you need to monitor, review, and do controls thereafter, and do report under the risk management as well as on the business side. That is how you do counterparty risk analysis in the risk management department. Now it's 10:27, so next thing what we have to do is actually to see how the risk management department manage concentration risk. So we will take a break and we'll get into that subject, and we'll see how risk management department, because the concentration is mainly has to be managed by risk management department, because business lines will not know the exact total portfolios in the bank. They are actually much more concentration on the customer than overall bank's position. So risk managers need to actually look at the concentration risk um, before they approve facility. Moment actually when they get the facility paper, what they do is they will look at to which particular industry this facility belong, and they will look at the current outstanding of those portfolio, and they will see whether they are within limit. If it exceeding limits, they will advise the business unit. Board of directors have already approved limits, and your new facility will exceed that, therefore need to be approved by the board. So those limit checks also been done by credit risk department, and we will see how they manage concentration risk after taking a break. In the meantime, I want to ask you if you have any doubts of things what you have discussed so far. You can use the chat box and post it so I can answer them. And want to tell you one thing. Actually, your paper has, I think, 8 or 10 questions for you to write for, I think, 5 questions. So you have a choice there, and you have only one particular question from this session what you have done last Sunday and today. So I prefer that if you have mastered this, accept this particular question and answer, because it will give you great knowledge about risk management, especially credit risk management, the things what you have discussed, which is an important area in the bank. Right. Okay. We'll. If you have any questions, you can put me on chat box, and we'll take a break. You all hear me?
Yes, sir.
Yes, sir.
Right. I went through the chat box. There's question on Basel. They want to know the Basel concept. Basel concept is, I will let you know, the Basel concept is actually an international law. For risk management purposes, they have done in 1998. They thought major risk of a bank is credit risk, and then they wanted the credit risk portfolio to be risk weighted and arrive at a risk weighted average. So risk weighted average will be based on credit rating of the customer, and credit rating of the customers that time it has not been done. was something new. In 2004, when it was introduced in Sri Lanka, we started the credit rating system. And until credit rating system is done, central bank gave us some guideline how to risk weight the assets. So we call it standardized approach, and based on that, we risk weight the assets and arrive at a total, and we divide our equity by that risk weighted total, and into 100 we arrived at a capital adequacy ratio. And in Basel II, the capital adequacy ratio was 10% was sufficient. When we introduced Basel III in 2019, this ratio was enhanced to 14%. That is the concept actually we have in capital adequacy. So Basel committee recommendation is coming from World Bank, and it is a kind of a regulator. Local regulator also adhere to that, and therefore local regulator will issue direction based on Basel recommendation to all the banks in Sri Lanka to adhere to their regulations. Right, that is about the Basel 1, 2, 3 and the concept. Now we go into concentration risk measurement. Banks actually analyze concentration by credit quality. Now, if you have overdrafts, which are, now we'll say, I have taken this, when you see this table, you see every quarter in 2015, I have analyzed the bank's portfolio. In 2015, September, total loans were given is 98 billion. 12, it is 100 billion. And in March 2016, 105. Because loan portfolio grows, that's how the banks operate. Based on deposit taking, the loans also will grow every quarter, every annually, and so on. So you can do the quality analysis on a quarterly basis. Quality analysis has, you take the total loans and advances, and you divide them into how much your non-performing advances, how much performing advances, and how much are overdue. Here what I say is, performing is if you have take overdraft, customer operates within limits. And there is always operation, and if you take a loan, not a single day is been delayed, he paid his dues on time. Overdue means customer has few days delays up to 90 days. Generally, if a loan overdraft which is passing 90 days or 3 installments due, we consider as non-performing. So overdues are actually relevant in banks because they are, you don't expect the customers to pay really on time, but they are not non-performing. They are a little bit irregular, but also a factor to consider. So if you divide the first quarter, that is here 98 billion, loans of 75 billion are being paid on time, not a single day delay. Then up to 90 days, 15 billion is there. Then over 90 days, 8 billion has not been passing the 90 days, not been repaid. Second quarter you took it, you have increased your non-performing. Your PLA has increased by 1. Your overdues have come down by 2, but your non-performing has gone up to 10. So which is also not a good sign, because NPA ratio is the one we take as a indicator of the quality of your credit. So on the third year, you have increased and you have got down to NPA to 9. So when you calculate percentage, there is a drop in NPA in the March 31st of 2016. Again, June, it has gone up to 10, but you have increased your loan portfolio to 150. So you do a NPA is calculated, NPA divided by total loans. Now we'll take second quarter, that is 30th December 2015. Your NPA is 10 and your total loan is 100, so you have 10% NPA. Here, for the sake of I am putting it, these are all figures, hypothetical figures. 10% NPA in a bank is very high percentage, but for purpose of learning only, we put this. A small hiccup came. Can you see the slides? Hello, can you see the slides?
Yes, sir.
Right, okay. We were on quality analysis of your credit. So we overdue is also something to be concerned, because these, when customers default 1 or 2 days and going up to 90 days only, those are one which get convert to NPA. These overdues as NPAs, you need to actually monitor, especially overdues, you need to monitor and collect your money. NPAs, you need to recover money, because certain actions has to be taken if after 90 days goes. Then this is a very important slide, because central bank wants our industry sectors. They have given us certain industry sectors and request us to put our loans and advances into those sectors. Now, one is agriculture and fishing, they have given, manufacturing, tourism, transport, construction, traders, new economy, financial and business services, infrastructure, other services, and other customers. Now, these are the sectors central bank has given us. They also says Now, agriculture and fishing, because Sri Lanka is a kind of agricultural economy, they want banks to support this particular industry, and they say at least 10% of overall total lending should be diverted towards agriculture and fishing. That actually to make sure that livelihood of farmers and fishermen is to be funded by banks. Then manufacturing to the rest, actually there is no regulatory limit, but based on the performance of that particular industry, banks allocate their own limits. Now, this particular bank, I just took the rough idea. They had 100 billion worth of total loans. 10% they have put into agriculture and balance. Manufacturing is anyone who is engaging kind of manufacturing products. Tourism, transport, construction, which include housing, uh, commercial buildings, then also apartments, all that could come under construction. Traders, import-export traders, your retail and wholesale traders. New economy is an area actually which has taken a lot of focus now, because you do things using virtual platforms like uh, e-commerce. Uh, Actually, those are dot-com companies. Uh, Nowadays, there's a great demand for those who can actually do business through internet and various other forms. So, new economies about that. Financial and business services include other financial services, other financial companies like asset leasing companies, so on, finance companies. So banks lend to them also. Infrastructure are major projects like road development. Other service areas, you get doctors, engineers, auditors. They provide various services. They also need funding. Then other customers include your retail clientele, credit cards, bonding, and your personal kind of loans. So the first year, end of 2017 here, um, bank had 1 billion, 100 billion. And this point, they will invite the risk department along with the finance department to prepare a budget somewhere in November. In that, they will identify your loan growth. Now here I can see from 100 to 200. So bank wants to expand 20% in the loans and advances, and finance and risk department will have to jointly together identifying the risk, and the credit department jointly, they must actually give these figures, how much they are going to lend to agriculture, whether manufacturing has an opportunity to increase, whether tourism can further increase. Now, actually, 2017, we are on a real tourism drive. So that particular year, this bank has doubled the portfolio. Now, I think it is the other way about it, because when things are not doing well, you will actually not make major increase in these limits. So the 120 they have allocated in this manner to accommodate the increased loans and advance. So this is how you manage. Now say you get a customer in 2018, and he will say in the construction sector. Um, Now, construction sector bank wants to actually expand from 20 billion to 25 billion. So you can accommodate 5 billion during that particular year, additional facilities, plus anything repaid also can be considered for further grant facilities. So at the end of the year, you should not have exceeding 25 billion on the construction industry. This is how this particular budgeting is being forecasted. So this is an important slide where, because central banks, there's a regulation by the agriculture, you need to keep 10%. Rest actually bank need to consider what is their strategy. which departments, which industries they would like to lend based on the economic performance of those industries. Therefore, they will avoid NPA. Now, we can also take product by product and also analyze the concentration. Now, we take one product of the bank in the loan section is the overdraft. Now, this particular bank, I told you it has originally had 100 billion loans and advances. So we say out of which 40 billion is given as overdraft. Overdrafts also you can categorize into various buckets, like any customer who is operating within limits. Now, out of this 40 billion, 29 billion is operated within limits. Those customers don't do excesses. Then some customers, they have a limit, but they exceed that limit and go further. And those customers are 8 billion. Excesses without limits, these are casual type of overdrafts. Generally, branches will have to accommodate those customers. And then those items are 3 billion. So overall excess is 11 billion. Why do we analyze like this is to see the riskiness. When a customer get a facility without limit, that means the relationship is on a very temporary basis. And the chances of defaulting is high. So you need to actually categorize those and monitor them very thoroughly. Excessive approved limits also not a good sign because those customers are over trading. So you need to actually see their exact requirement and enhance their facilities. Otherwise, that will become a threat or a risk factor for the bank in the overall situation. So this type of product analysis also be done. You also can do this for pawning. Now say I took the entire pawning base as 10 billion. 8 billion is performing. That means the pawning advances pawning is a product come under Pawning Act. You take a loan. It's kind of a loan, actually, pawning ticket, which actually no repayment is required until 1 year, and as per that act. So the bank cannot actually, during that 1 year, demand any payments. So pawning product, you give facilities against the gold. Bank is really not giving the full value of the gold even at the time of assessing. Certain banks have loan to value ratio. That means value is the value of the gold what they keep as collateral. Loan to value means if the gold is worth 100,000, if you give 65,000 as pawning, then your loan to value ratio is 65%. So what here we have checked is overall total portfolio is 10 billion, out of which customers are within that 1 year 8 billion. Overdue is year has passed, but they have not redeemed. So that comes to another 1 billion. Non-performing is if it is not redeemed, then what you do is you give 14 days notice and auction them. Sometimes in these auctions, you won't be able to get the value outstanding, either due to price fluctuations, whatever. Then what happens is, in the auction itself, even you can't dispose this one. You may have to dispose at a loss. Those are actually considered as non-performing. So we need to actually monitor overdues and non-performing in a portfolio of pawning. Leasing also you can look at performing and non-performing. You can categorize the type of leases you are given. Some you have given for vehicles, some are given for machinery. Then you can identify whether to give loans on machinery. Some people think machinery is risky because machinery can be, doesn't have absolute ownership for the bank. As a result, you cannot repossess. And if it is fixed to the ground, actually machinery is much more secure because customer can't move the item here and there compared to a vehicle. So this is how you analyze certain portfolios. Now we actually analyze leasing, we analyze bonding, we analyze the overdraft. That's how we really do. You can apply this to your loan portfolio. Any product type you can apply. Now we go into an area where another aspect of risk management. Risk management, credit risk management actually need to forecast. You remember we did that formula, expected loss equal to probability of default into exposure at default and loss given default. Similarly, if the economic activities are not good, credit risk department have to do some tests. Those tests are, we call it stress test. And stress testing of credit risk is a very important aspect and a responsibility of the credit department. Now, how we do this is simple, because now say, okay, we'll take for instance, in 2019, beginning of the year, we identified the COVID patients and a foreigner who came, we identified, and Chinese national, she was treated at IDH and recovered and went. But during that time, the worldwide pandemic situation erupted. Now, Sri Lanka didn't take much action uh, in the sense that we didn't order our doses, the injection doses in time. We didn't close our borders in time. So, and health advice given to citizens also didn't follow their advice. Due to various reasons, spreading of this was inevitable. So, if you are a banker at that time in the credit risk department, you may need to actually forecast certain things. If this spread to Sri Lanka, what will happen? You know what has happened already. So I'm going back into previous years. In 2019, our risk department would have identified this, saying that the pandemic, if erupts in Sri Lanka, the main industries which are going to get affected is the tourism and transport. And if we have credit exposure to them, we may they may need to downgrade them or classify them, provide provisions, because they are definitely not going to repay when a situation of that nature. So increase in NPA and provisioning is a kind of a result which will come. So what you have to really at that time request, looked at each and every facility given to hotel sector and tourism sector, you would have examined it and identified vulnerable facilities. That means which can go into bad because they don't have other businesses or other cash flows to pay, and done some rescheduling and various other things. Actually, government was more active in this consent. The moment this came, they request the bank to apply a moratorium. That means they looked at the customer side and they knew that they are unable to pay. They asked for time for these people to pay, and the time sometimes without interest, and therefore bank's credit risk got increased. So this moratorium period, during that time, some customers had the ability to repay, but when the government gives that, they sometimes use the complete moratorium for them to take that time for repayment. So the process of assessing performance under adverse conditions is a type of test we call it stress testing. What will happen in this test? We are going to arrive how much it will go into NPA. As a result, how much profit we are going to lose, how much provisioning we have to do to take out from our current profit, and arrive at the overall profit. So when the overall profits go down, it will also affect our capital adequacy because the capital is going to get reduced. Negative shift in NPA category and increase in provisioning is the result of this. And what happened when that comes, sometimes you may not be able also to do your recoveries because sale value of properties what they have mortgage also can come down because people doesn't have money to buy. So this situation has already occurred, and I think from pre-pandemic era to now, most of the banks have recorded high non-performing advances ratio, and if it is under moratorium, actually banks do not have to calculate them under NPA. So once the moratorium is over, I'm sure NPA is going to go further up because those customers still have not recovered from the um, pandemic situation and the not businesses are regular as before. So these kind of tests also need to be done by credit risk department. We call them stress testing. This is a very important area because to assess the credit quality of your bank, they use certain indicators. We call them key credit risk indicators. And main credit indicator is the gross non-performing advances ratio. Now, you need to, you can, this calculation by yourself, even if you're in a branch, you can take your gross NPA, divide by your total advances into 100, will give you a percentage, that is your gross non-performing advances ratio. Now, I invite you to check your banks by looking at last year's annual report, or if you can access to banks' financial statements, they have to actually disclose this particular ratio to even public nowadays, because this is the ratio which will actually judge what is the quality of your advances you have given to customers. Higher the gross NPA ratio compared with the industry standard, bad is your advances portfolio. So most of the banks actually try hard to keep this gross NPA ratio something like less than 3%. Unfortunately, due to pandemic, now some banks record even more than 5% this, which is very much higher than kind of a industry norm. The second ratio can you see the slide?
No, sir.
No, sir.
We were talking about gross NPA, and the net NPA is actually you reduce in a bank when you do non-profit your NPA. You have also NPAs which have gone more than 6 months. We do some provisioning. We also have non-performing overdrafts. So the interest on those we don't take it into our profit. We call it interest. We put them into interest in suspense. So our net non-performing is you take the total NPA, reduce your provisions made on non-performing advances, and also you reduce the interest in suspense, which is available for you to actually collect, but at the moment they are not being taken into a revenue. So that way you calculate your net NPA. So net NPA divided by your total advances into 100 will give you a net NPA ratio. And so it's another way of assessing the credit quality of your bank. That is, you deduct from the total gross NPA the already made provisions, because those are available for you to deduct when those losses occur. Then we also apply another ratio called open credit cover. Now we call it a provision cover. This is a very important ratio because this will tell you how much provisions available in case all those NPA in your bank goes bad, and then how much you can recover from your provisions already made, and what will remain for you to take it out from your profit and loss account. So you take your gross NPA, you divide by specific provisions what you have already made. Then you get your specific provisions, you divide by NPA into 100, will give you a percentage of how much provisions available for you to take into those losses. And you have to turn this the other way about. Specific provisions divided by gross NPA will give you a provision cover. Provision cover should actually exceed 25% for you to in business. That means from all your bad loans, at least 25% of should have been made provisions, so that in case of a loss, that bank will not have a huge impact on the profitability. Open credit cover is another ratio we generally take as a key risk indicator, which is to actually look at you take the net NPA, you divide by your equity capital. So this what we will look at is, we look at how much from your capital if you have to allocate in case of these accounts goes into loss position. Because earlier one we take the gross NPA, now here we take net NPA. Net NPA is minus provisions as well as interest in suspense. So in case of a loss, you have deducted your provisions, your interest in suspense, then you arrive at the net NPA. Net NPA is the one which need to be funded either from your existing profit and loss or from the shareholders' money. So if the existing profits are not there, the shareholders' money will be applicable to compensate those losses. And as a result, what will happen is your equity will get diluted, and then your capital adequacy will get affected, and bank is in a bad form. So you somehow see that your open credit cover remain at lower level in order to survive. Similarly, you can apply another ratio called overdue advances ratio to performing advances ratio. Overdue means, you remember, which I mentioned, it is not NPA, but those are not regular in the repayment. 1 to 90 days not paid, therefore we consider them as overdue. And when you compare with your entire performing advances, you get a percentage. That percentage, higher the percentage means more vulnerable credit portfolio, and you need to actually correct the situation. So these are the other ratios. We actually generally credit risk department compute this, and then on their monthly report they report this to the board of directors for them to assess the credit quality of the bank, because they don't write these calculations with itself will give an indication of the board of directors to see the quality of the credit what the bank has granted. So with that, I think we conclude our syllabus on this. And what you need to actually understand is mainly we touch two areas, that is credit management and the credit risk management. Now, under credit management, we actually looked at the counterparty risk. Counterparty risk is default of customers. We concentrate more on concentration risk under the credit risk management. And certain portfolio analysis, certain product quality analysis were done at risk management level. Also, risk management level, they looked at various statutory requirements like single borrow limit, the related party transactions, and also we looked at industry type exposures to adhere to regulators' requirement. With that, I think we will conclude our um, credit risk management and in your credit on your credit management diploma. I will combine in this question what you get for the paper is single questions, which I think the question number 8 is generally the credit risk management paper, question in your paper. It generally may consist of kind of a case where counterparty risk is indicated, and we will ask you how can you identify, measure, and mitigate that risk. So we'll take for an example, we'll say you have a import export customer, and we'll see his requirement of getting things into Sri Lanka. That means he will have to establish the letter of credit. We will ask the risk factors involved in his trade. You know that we already discussed country risk, foreign exchange risk. Then also we have to look into the status report of his buyer, if it is exporter. If it is in a different country, you send goods from here, and if you have to make advance payments, if you have to make open, send it on open account, what will happen is non-payment may occur due to the reliability of your buyer abroad. So to avoid that, you may have to request the bank to obtain a status report of the buyer before you engage in trading with him. So we will ask similar question. How do you make the process going? That is, how to identify and measure. And then we also request you to mitigate. Mitigation can come from either collateral cover, covenants, or the price. The evaluation is what is important, before getting into identifying the risk. Evaluation will help you to, identify. We discuss financial evaluation and qualitative evaluation. Financial evaluations, we discuss about the ratios, and ratio question will be there from another module. So I am not actually particularly asking for you to compute ratios and indicate, but in your evaluation, you could, if you can just mention financial evaluation and qualitative evaluation is to be done on the customer, and also it need to be jointly approved with the credit risk department is important. Another aspect question can come from the internal rating module, part from the internal rating module. The internal rating module will give you an indication of the customer's creditworthiness. Generally, internet rating module will apply to corporate clients. If it is a retail client, you need to apply the credit scoring method or a 5 C's of good credit. If it is a SME client, you may have to apply his financials versus management, which I talked to you earlier, company versus industry, all that things what we have discussed. So I hope you can do the slides one more, look at all the slides what we have mentioned, and then get ready for this particular question. Anything, any doubtful, you can put me on chat and I will give you a little more time for us to discuss.